silver did not just break a record, it shattered an illusion. At $56.45 per ounce, the market sees a dramatic surge that climbed nearly 6% overnight. Investors call it momentum. Traders call it volatility. Commentators call it speculation. But none of them see the deeper mechanism that has been building throughout the year. Because in 2025, 3 specific policies from the Trump administration were finalized one after another, each appearing ordinary on the surface, yet together forming a structural force that Wall Street still has not fully priced in. Not in their models, not in their forecasts, not in their assumptions about supply, demand, or risk. And the most explosive catalyst remains almost invisible to the public. Silver has now been officially designated a critical mineral of the United States. This marks the first time in American history that silver has been elevated into a strategic category beside metals like copper and rhenium. This single classification transforms the entire landscape. It triggers fast-track mining approvals, military stockpile funding, enhanced tax incentives, and supply chain privileges that did not exist before the final USGS list was released. So the question is no longer why silver is climbing. The real question is how far this systemic shift can drive the price once these policies collide with a global deficit that has already persisted for 4 consecutive years. $56 is not the destination, it is the ignition spark of a new cycle, one that points directly toward the $100 threshold. To see why this matters, we need to uncover the forces that actually drive the silver market from beneath the surface. At the center of this transformation lies a simple truth. Silver moves according to 2 engines, and when both accelerate at the same time, the entire market enters a different regime. Silver is not powered by a single narrative. It runs on 2 engines that pull in opposite directions, yet accelerate each other when the system reaches a point of strain. The first engine is industrial demand. It accounts for roughly half of all global silver consumption. Solar panels, electric vehicles, high-frequency 5G electronics, defense systems, grid infrastructure. These are not discretionary uses. They are essential components of the modern world. According to the World Silver Survey 2025, industrial fabrication reached a record 680 million ounces. For the 4th consecutive year, the global market fell into deficit, this time by 184 million ounces. Solar alone absorbed 190 million ounces in 2024 and is projected to surpass 220 million ounces in 2025, even with improvements in silver loading efficiency. The second engine is monetary demand. Silver behaves like a financial pressure valve during periods of currency weakening, debt expansion, and negative real rates. It responds to fear, inflation, and systemic uncertainty. These 2 forces rarely peak together, but when they do, the result is not a simple price rally. It becomes a structural compression of supply against demand. A tightening that does not resolve itself through normal market adjustments, and it is within this compressed environment that the first Trump policy strikes with maximum impact. Policy 1. Silver becomes a critical mineral. The first policy is the most misunderstood, yet it is the foundation of everything that will unfold in the coming years. On November 7, 2025, the United States Geological Survey released the final 2025 list of critical minerals in the Federal Register. And for the first time in American history, silver was added to that list. This was not a symbolic gesture. It was a formal recognition under Section 7002 of the Energy Act of 2020, a law that mandates a full reassessment of essential minerals every 3 years. The draft list published in August included 54 minerals, but the final version confirmed silver's elevation with a specific justification. Silver was deemed essential to the economic and national security of the United States, with a high risk of supply disruption. Once a mineral reaches this status, the consequences are immediate and structural. Critical designation automatically unlocks fast track, permitting for domestic mining operations in high-potential states, such as Nevada, Idaho, and Arizona. It activates pathways for Defense Logistics Agency stockpiles, giving the government authority to accumulate physical silver directly for national reserves. It grants enhanced tax credits for United States processing facilities, protections that the Trump administration chose to preserve within the modified IRA framework. And it creates priority access within trade agreements with key allies like Canada and Australia. The underlying question is why silver qualified at all. USGS assigns critical status using 3 core criteria, and silver rated high in every single category. Criterion 1. Economic importance. Silver plays an irreplaceable role in solar photovoltaics, which now consume nearly 20% of global supply. It is essential for EV battery contacts, high-efficiency power electronics, and 5G infrastructure. Criterion 2. Supply risk. The global market has operated in deficit for 4 consecutive years. Mine output remains stubbornly flat at 825 million ounces. Recycling contributes only 260 million ounces. Total supply cannot rise above 1,085 million ounces, while demand already exceeds 1,200 million ounces. Criterion 3. National security. Silver is embedded in defense electronics, surveillance networks, and energy systems that the Department of Defense cannot function without. This classification was not an accident. Months earlier, on March 19, 2025, the administration issued the executive order titled Immediate Measures to Increase American Mineral Production. It explicitly prioritized metals like silver for accelerated development and strategic stockpiling. The result is an intensified global squeeze. Known reserves cover only 18 months of consumption at current production rates. Analysts at Solomon Global now argue that $100 per ounce by 2026 is feasible based on industrial demand alone, a projection that becomes even more forceful once monetary pressure enters the equation. Policy 2. The debt explosion and the engine of monetary pressure. The second policy does not target silver directly. It reshapes the monetary environment that silver thrives in. The United States entered 2025 with deficits widening at their fastest pace in decades. By August, the national debt had already reached $37.23 trillion, and the Congressional Budget Office projected a debt-to-GDP ratio rising toward 118% by 2035. Against this backdrop, the Treasury announced its fourth quarter 2025 borrowing schedule. More than $1 trillion of new long-term bond issuance would be required simply to finance the expanding deficit. None of this included additional emergency spending or energy infrastructure commitments. The Trump administration reinforced this trajectory through the Unleashing American Energy Executive Order. It rejected spending cuts in favor of large-scale funding for domestic energy dominance. New pipelines, refinery upgrades, export infrastructure, and strategic supply chain initiatives all demanded capital. The result was predictable. The United States would borrow across the entire curve, saturating markets with supply and pushing real interest rates downward. This is the environment in which silver historically transforms from an industrial metal into a financial pressure valve. The 1970s debt spiral drove silver up more than 1,200%. During the 2011 European sovereign debt crisis, silver accelerated 150%. When government obligations grow faster than tax capacity, precious metals respond to the weakening of monetary credibility itself. The gold-to-silver ratio illustrates this stress clearly. The current ratio sits near 74-1, well above the long-term average of 50-1. If gold rises toward $3,750, a normalization of the ratio alone would pull silver toward $75, even without accounting for deficits, stockpiles, or industrial strain. Central banks amplify the pressure. China added 2,300 tons of gold to its reserves in 2025. Other institutions increased purchases even as Russia liquidated part of its holdings. Meanwhile, the dollar index weakened and real rates turned negative heading into the first quarter of 2026 as markets anticipated additional Federal Reserve rate cuts. Major financial institutions now converge on a clear range. BNP Paribas project $100 by the end of 2026. Bank of America targets $65 at peak. UBS anchors forecasts in the mid-50s. Even conservative Reuters polls cluster between 50 and 65. All share the same foundation: structural deficits, monetary pressure, and the accelerating shift toward physical precious metals. And within this tightening environment, the third Trump policy delivers the final accelerant. Policy 3. Strategic trade exemptions and the industrial surge. The third policy strikes at the industrial core of silver demand. On September 5, 2025, the administration issued a sweeping executive order that exempted more than 45 import categories from new tariffs. These exemptions applied specifically to aligned trading partners and, critically, included components built around silver, nickel, graphite, and solar polysilicon. On the surface, these exemptions appear to be routine trade adjustments. In reality, they were designed to prevent production bottlenecks inside sectors that the United States considers strategically essential: electric vehicles, high-density electronics, solar panel manufacturing, semiconductor-adjacent components. Every one of these sectors consumes silver at scale. The policy built upon the earlier July 29th executive order that ended the de minimis import loophole. But while that earlier order tightened controls, the September exemptions loosened the flow for critical industrial materials. The objective was clear: keep factories running at maximum capacity without being constrained by tariff delays or supply chain friction. The Silver Institute projects that electronics and electrical systems will increase their silver consumption by 90 million ounces across the next 2 years. Solar photovoltaics will continue expanding even as silver loading efficiency improves by 10 to 12%. This is because total global installations continue accelerating. In 2025, industrial fabrication is already projected to hit 680 million ounces, the highest level ever recorded. Automotive applications alone are approaching 90 million ounces with double-digit year-over-year growth. 5G infrastructure adds another 180 million ounces. The International Energy Agency reinforces these numbers. Global solar additions are moving toward 380 gigawatts per year. At 133 metric tons of silver per gigawatt, the demand profile becomes inescapable. The strategic exemptions therefore do more than protect manufacturing. They ensure that industrial silver demand grows without interruption, even during periods of monetary tightening or geopolitical stress. And once these three policies converge, the mathematics of the $100 scenario becomes unavoidable. The price projections surrounding silver are not built on speculation. They are built on arithmetic. When the three policies collide with the physics of solar expansion, the numbers begin to move in only one direction. Every gigawatt of solar capacity requires 133 metric tons of silver. That is not an estimate. It is a structural requirement embedded in the conductivity, reflectivity, and efficiency thresholds of photovoltaic cells. Even with ongoing improvements in silver loading, the global volume of installations grows faster than efficiency gains can offset. In 2023, the world added 346 gigawatts of new solar capacity, absorbing roughly 155 million ounces of silver. In 2024, installations are expected to reach 380 gigawatts, pushing consumption beyond 170 million ounces. 2025 projections climb even higher, as utility-scale solar dominates new grid additions, accounting for more than 80% of total US expansion. This is the environment into which the three Trump policies inject additional demand pressure. Policy 1 accelerates domestic mining investment by unlocking critical mineral incentives. Policy 2 increases the monetary premium on silver as deficits and real rates deteriorate. Policy 3 ensures uninterrupted industrial imports, allowing factories to scale without friction. When these effects are combined, the pricing models shift. A conservative calculation begins with the $56 base, applying a 16% uplift tied to solar demand growth, then a 20% monetary premium linked to inflationary pressure, and finally a 10% supply squeeze driven by critical mineral constraints. The result is $96 per ounce. This is not an outlier projection. It is the midpoint of a realistic range between $75 and $110 once all structural forces are accounted for. History reinforces this trajectory. In 1980, silver spiked from $10 to $50 during a similar blend of deficit pressure and monetary instability. In 2011, the European sovereign debt crisis drove another surge toward $50. In both cases, the gold-to-silver ratio collapsed from above 80 to the low 40s. The present conditions mirror those past cycles with remarkable precision, and that is why the conversation must turn to risk, volatility, and the strategy required to navigate the final phase of a structural bull market. Every structural bull market carries its own form of volatility. Silver is no exception. It moves faster than gold in both directions. And when the system tightens, corrections can appear violent, even when the long-term trajectory remains intact. During the first half of 2025, a sharp pullback briefly shook the mining sector. ETFs such as GDX declined, only to rebound as silver retook leadership. The same pattern repeated in the most recent consolidation. Silver dropped barely 2% from its highs, while gold retreated more than 4%. Short sellers in SLV were forced to unwind positions rapidly as liquidity tightened. This is the nature of a metal that sits at the intersection of industrial necessity and monetary stress. It does not decline gently. It compresses energy, then releases it. A rational approach requires mitigation rather than prediction. Pairing physical silver with oil-focused ETFs can stabilize drawdowns, since energy assets currently offer yields near 3.6% and help offset cost pressures faced by mining companies during periods of volatility. But the core of a resilient strategy is physical accumulation, allocated metal, not synthetic exposure, not unbacked paper claims. Premiums on American Silver Eagles remain unusually low at $2 to $5 over spot, a window that rarely stays open once monetary cycles shift decisively. The final variable to watch is the Federal Reserve. Multiple analysts expect a 25 to 50 basis point cut at the December meeting. A confirmed turn toward easing would place additional downward pressure on real interest rates, accelerating the very conditions that push silver higher. In this environment, volatility is not a threat. It is a signal of structural tightening. And the final step is to understand what this tightening represents at the system level. When viewed in isolation, each policy seems modest. A mining classification, a borrowing schedule, a set of tariff exemptions. None of them appear powerful enough to reshape a global commodity, but markets rarely transform because of a single dramatic event. They transform when multiple structural forces align in the same direction, quietly, consistently, and without announcing themselves. The designation of silver as a critical mineral rewires the supply architecture of the United States. The explosion of federal borrowing reshapes the monetary environment that silver reacts to. The strategic trade exemptions ensure that industrial demand continues without interruption. These forces do not compete. They reinforce one another. That is why the $56 price point is not a peak. It is the opening movement of a deeper systemic pattern, a pattern defined by 4 consecutive years of market deficits, a pattern driven by solar expansion, electrification, and national security priorities, a pattern intensified by monetary pressure and structural debt. History shows the consequences. When deficits collide with inflation risk and industrial scarcity, the system does not drift toward equilibrium. It snaps into a new price regime, 1980, 2011. Each cycle left a clear signature, and the present cycle mirrors both with remarkable precision. Silver is no longer just an industrial metal. It has been pulled into the architecture of national power, monetary defense, and technological expansion. The price is simply reacting to the system that now surrounds it. If this opened your mind, stay curious. The next story is already unfolding beneath your feet.